the growth managers need a new growth industry to rotate into, and it's been healthcare. And I happen to have one of those stocks. And that company is called KORU Medical, KRMD. It's my subcutaneous pump company. And it's gotten cheap for a healthcare company with low to mid 20% revenue growth and, mid to high 60% gross margins upon, a little more scale. It's a small company. They did 41 million in revenues last year. We're going to do 50. I have them doing 51 this year and 64 million next year. So this is not a big business, but it's only the first or second inning of subcutaneous drug delivery. There's a massive shift from IV delivery to subcutaneous delivery because it's just easier. You can do it at home. It's easy to do in the clinic. In a infusion clinic, one nurse can oversee 4 or 5 of these, and they get done in like a third of the time of an IV. So the throughput at the infusion clinic could be double, at least, if not triple IVs. It's just a great little, company. They have a leading share in this business because it's, it has been a small niche. But major drug companies seeing this are actually developing some of these liquid drugs for subcutaneous before they do the IV version, which is a major change in how drug companies go to market. So this company makes the pump, they make the delivery system, the tubing and the needles, which are consumables. So 75% of their business, 80% of their business is consumables. It's just a great little niche story. And it's been overwhelmed by everyone piling into the data center trade, in my opinion. So the stock, which we bought here a couple of years ago at 2 and change, 230, 240, got up to 6.5 last year. And then when the data center trade, hit, this thing pooped out and went down to about $3.90, $4. In my opinion, the visibility to 25% growth as a stretch goal is reasonable. So that's what I'm using. And that makes this stock under 3 times EV to sales. They're not very, profitable because they're in their, strong growth phase. So they have a lot of submissions and tests and new markets they're opening up with SG&A. But, they want to get to $100 million in revenues in a few years from 40 million last year. And if they do that, this business should be at least worth 5 times sales to Becton Dickinson or somebody like that. It's a great little business. It's starting to get some attention now because growth managers, they want to rotate out of their semiconductor stocks. And therefore, this is a phenomenal candidate for the small cap growth portfolio manager.